Well, good day, everyone, and welcome to Financial Planning Day's Debt Management Seminar. My name is Melanie Hardie. I'm a certified financial planner and an accredited financial counselor and a proud member of FPA of Minnesota. I'm going to be presenting the Debt Management Seminar to you today. So let me share my screen and we will get started. I hope you're all enjoying my beautiful little beachy background that I have for my Zoom meetings. Although, it's a nice background. I think I'm going to stop the video so I am not distracting you from the slides that we have. Here's the disclaimer for the debt management seminar while I change my and stop the video. You'll still hear my voice, but you won't have my little picture there up in the corner to distract you. So this is intended for you to use. It's a recording, so you can view it as many times as you need to. Let's get started. So I think it helps to connect our values with our money. And sometimes when a financial plan we're working on gets tough, if we can connect back our goals to these values. So read these words, these value statements, and think of a couple of them that are important to you: financial security, taking care of family, relationships, honor, independence, whatever connects with you. That's going to be what is going to motivate you when things get hard. So I want you to keep those in mind. So here's the big picture. Here's sort of the main aspects that we're going to talk about today in helping you to figure out how to get out of debt. So no one really wants to do the hard stuff financially, but if you come to this seminar, it's because you want to get out of debt. Now, there's no easy way through this. There's no quick fixes. It's a process and it's going to take time. So you have to be committed. And again, going back to those values, if something is important to you, you need to take the hard steps and the long journey that it will take you to get there. So you need to figure out where your money's going. Maybe cut some spending, look to increase income, decrease spending, and we'll talk a little bit more about that later. Make a list of all of your debts. Maybe look for lower interest rates or transferring balances. Maybe deciding which debt you're going to pay off first, whether that be lowest balance, highest interest rate, and then move down the list. And I'm a big proponent of starting with small balances and working your way through the list from smallest to biggest. That way you have the snowball effect and it has a really positive psychological benefit. So if you're not really sure who and how much you owe, it may be that you need to pull your credit report because everything will be listed there. And did you know that you could get a free copy of your credit report once every 12 months from each of the 3 national credit bureaus? Now I do this too, and I do it to monitor my credit. Like I'll pull my Equifax report in March. Then 4 months later, my Experian in July. 4 months later, my TransUnion report in November. And then 4 months after that, I'm back to Equifax in March. Through annualcreditreport.com. Now, there's other sites like Free Credit Report, but it's not free. You have to sign up for a credit monitoring service. And the credit reports from annualcreditreport.com will not give you your score. If you want to look and pay for the actual credit score that lenders see, your FICO score, you can go to myfico.com for both reports and scores, but there are costs for that. Now, you don't need to do that. You can get your free credit reports through annualcreditreport.com. And there are some free services like Credit Sesame and Credit Karma that will give you a close approximation for free for your credit scores. They're not the FICO, but they're pretty close. So you can do all of it for free. You don't have to pay for these. All right, getting out of debt. That's what we're here for. That's what we're here to talk about. So if you're going to get out of debt, you have to stop incurring debt. So that means putting a freeze in your debt, halting any new charges. Now, if you're not going to be using credit, you're going to have a little bit of savings because unexpected expenses are going to come up. Whether it's $500 or $900, a small amount of savings will help you avoid having to use credit or incurring new debt. So even before you start paying off your debt, build a small savings. Look for some creative ways of building up some savings while just treading water with your debt. Any additional income, side jobs, cash jobs, selling things, overtime, bonuses, refunds, anything extra you can get, put it in savings so that you have a small emergency fund. Make sure you set realistic goals. Again, if you're going to get out of debt, focus on paying off one card or one debt at a time. So you pay the minimums on everything, and then anything extra you have, you would focus one debt at a time. You might also look at pruning your plastic or pruning your credit. Avoid impulse purchases. Nothing within 24 hours that isn't just, let's say, on your debit card. If you've got a bunch of store credit cards that you found on your credit report, you might even consider closing those. I know I've opened some in the past when I'm at a store and they offer me a 15% discount by opening a credit card. But if you're not using them, close them. Don't carry your credit cards with you. Just like I said up above, freeze your debt. I actually coach people to take their credit cards out of their wallet, stick them in a Ziploc bag, and put them in the freezer. Now you need them, you can get to them, but you have to think about it. And you have to wait for the ice to melt to get at those cards. Just carry your debit card. It's just like a credit card, but you can't spend what you don't have. And have your emergency fund. If an unexpected expense like a car repair or dental or vet bill, have a little bit in savings. So you're probably going to have to change how you manage your spending in order to get out of debt, because chances are your spending habits is what got you into debt. So here's some questions. Do I need it? How am I going to use it? Can I buy it later? How many hours do I have to work to pay for this? Is it a good price? Is it a good quality? Maybe I can find it used. What I'm asking you to do is to think about it. Change your spending habits. Change how you spend. Think about things before you spend. So here is the dreaded budget. Now I know nobody likes the word budget. It may as well be a 4-letter word, but it's a 5-letter word. And really all it is a budget, is a roadmap to your financial goals. So you wouldn't think about going on a road trip without a GPS or a map. I want you to think about your budget as a way to reach your financial goals. If your financial goal is to get out of debt, a budget is the roadmap to get there. So if you write down everything you spend money on, or your whole budget and your debts, and there's more going out than you have coming in, here are the 2 most fundamental strategies that you can impact your bottom line. Increase income and decrease expenses or spending. And a combination of both has the most dramatic impact. So $50 of increased income, let's say from adjusting your withholdings with your employer. So instead of getting a big tax refund, you get $50 more take-home pay. Decreasing expenses, cutting some spending, a little bit from each category, $10 from groceries, gasoline, eating out, entertainment. You can cut $10 off 10 categories. That's $100. And stay focused. Talk with the plan with your household members. Get everybody on board. Remember those values we talked about. There might even be some expenses that you can eliminate. If you're carrying credit insurance on your credit cards or mortgages, most of the time that's accidental death. It's not just life insurance. And so oftentimes they're not going to pay. Even if you've got disability coverage, if you're paying for any extra coverage, think about getting out of debt and getting those accounts paid off, and then you won't need these extra expenses. If you pay PMI on your mortgage because when you purchased your home, you didn't have a 20% down payment, call your lender. Maybe the balance has gone down, your mortgage balance, and the market value has gone up to a point where you can apply. There's usually a $300 fee to apply to see if you can drop the PMI on your mortgage loan. Remember the 24-hour rule for any new purchases. And maybe think about eating out, expensive entertainment. Maybe these are things that you can eliminate while you're focusing on paying off your debt. Remember, all those questions, do I want it or do I really need it? So we talked briefly about some of these options. So do it yourself, the snowball effect, where you pay the minimums on everything, and then you focus one debt at a time, usually the smallest balance first. Debt consolidation is sort of a financial buzzword. It could be an unsecured loan, although they're very difficult to get. Balance transfers, if you're getting offers to transfer balances for 0% or low interest, that might be an option. Or the secured options below of home equity loan, refinancing, or a reverse mortgage through HUD. Be careful with doing that. You're taking unsecured debt, credit cards, and attaching them to your most prized asset, your home. Unsecured debt becomes secured debt. So you really want to be careful. 9 out of 10 people who consolidate their debt without making any changes to their budget, their cash flow, or having a plan to not get into debt again, get back into debt. Within 3 years, they have doubled the amount of debt they have. So you're doubling down. Consolidation without a plan, whether it's unsecured loans, balance transfers, home equity, refinancing, any of those consolidation options, without a plan so that you don't incur more debt, can end up doubling down. If you're unable to do it yourself with the snowball method, you might consider a program through a local consumer credit counseling service or CCCS agency. And I'll talk a little bit later about how to get in touch with a reputable one. Debt collections, you may be able to make settlement arrangements. If you do that, where you settle a debt for less than what's owed, get everything in writing and keep all your paperwork for 7 years. If you're unable to pay your debts and you are unable to come to some kind of arrangements to pay your debts, you may need to look at bankruptcy. The 2 types of bankruptcy available to consumers are Chapter 7, where you eliminate unsecured debt, but you have to qualify for Chapter 7 on income and assets. You would always need to consult with an attorney about bankruptcy, so regardless of which option. But Chapter 13 is where you restructure your debt payments over a 60-month or 5-year repayment period. We're going to talk briefly near the end of this about retirement fund access and standoffs, or being judgment proof, as last resort options for paying debt. So here's a really good cartoon. I love this one, and it sort of emphasizes the caution about debt consolidation. I have just consolidated all my monthly bills into one monthly payment that I can't afford. And so again, consolidation without a plan is just a temporary fix or a bad choice. So make sure that you have a plan. So we talked about debt management programs, and I said I'd give you more information. So that's a monthly repayment plan usually with reduced payments and interest. You would make one monthly payment for a set number of months, usually those 5 years, through the credit counseling service. You want to find out, is it affordable to you? Does your budget allow you to pay your living expenses along with that monthly payment? This is only for unsecured debt, not for mortgages, car loans, or government debts. There are some small fees for these services. Nonprofits learned a long time ago that people who pay for a service are much more likely to follow through with it than people who get it for free. To find a reputable consumer credit counseling service, or CCCS, you want to go through the National Foundation for Credit Counseling, and here's their website, nfcc.org/agency locator, or you can call 1-800-388-2227, which will connect you to the nearest NFCC member agency to you. That's a national routing number. I know three things if an agency is a member of the National Foundation for Credit Counseling. They are nonprofit, they are low fee, and their goal is to help consumers get out of debt. So if you can't do it on your own, try a debt management program. Even before you consider bankruptcy, check with a local reputable consumer credit counseling agency. They may be able to help you. So sometimes you have retirement accounts or investment accounts that you're thinking about tapping into to pay off debt. I just want to caution you, consider all of the pros and cons before doing it. It may seem simple. It's my money and it's my debt and I want to use this money to pay that debt. But there can be huge consequences, tax implications. So you could end up with a huge tax bill at the end of the year. Long-term loss of investment growth for your future. You want to compare the growth, the tax, and the potential compounding costs, including the losses, to the fees you would pay, let's say, through a debt management program for 5 years, or if you self-managed it. Sometimes employers on 401k or 403bs offer loans. Would that maybe be a better option? I want you to, think carefully about doing that. I consider this to be a last resort. And again, you want to make sure that you have a plan, because if you're borrowing money from your retirement account, you have to repay that money with interest over 5 years. Granted, you're repaying yourself back and that interest is going into your account, but it is payroll deducted. And so that's like a wage garnishment to pay off those debts. That money comes out before you get your take-home pay. So you're going to have less money available to pay your living expenses. It can also make it really hard to continue contributing, and that may mean you might miss out on a company match. So be really careful about doing the 401k loan option. Also, if you leave your company or you're unable to repay that 401k loan, or you get laid off, the outstanding balance on that loan, whatever remains, is considered an early withdrawal if you can't repay it within 2 months. And if you're under age 59 and a half, it'll be taxed, and there'll be an early withdrawal penalty. It'll be taxed anyways if it's a pre-tax account. But if you're under age 59 and a half, there'll also be a 10% early withdrawal penalty. So this option should only be a last resort, and if you have that no more debt solution plan. So IRAs, or individual retirement accounts, aren't employer-based. You can't borrow from IRAs, but you could cash it out. So again, if you're under age 59 and a half, there will be a 10% penalty. If this was a pre-tax IRA, you'll have to pay income tax by adding the amount you cashed out to your income for tax purposes. There'll also be a loss of accumulated value. So the future value of, let's say, the $7,352, let's say you are, 40 years old. In 25 years, when you're 65, and even just a very conservative 5% rate of return, is almost $25,000 that you've lost to pay off $5,000 of debt. And here's how that came about. So the liquidating of an IRA to pay costs for $5,000 of credit card debt, to pay federal taxes, state taxes, and the 10% penalty means you have to withdraw $7,352. So the total cost is $2,352, and the total loss of value is nearly $25,000 in 25 years. Where the annual interest paid on that $5,000 of credit cards with a 16% interest rate is only $800 per year. So it's a huge cost to liquidate an IRA. So what I want you to think about is, again, be cautious of consolidation or looking for quick fixes. Now, reverse mortgage is another option if you're 62 or older and own a home, whether you've got a mortgage on it or not. You don't have to make monthly payments to this type of mortgage. They are highly regulated and require counseling through a certified HUD counselor. AARP offers a booklet, but again, I want to caution you, using a reverse mortgage without a no more debt incurrence plan budget that allows you to live within your means could end up being a Band-Aid. So remember, we talked a little bit about a standoff. If you're unable to satisfy your debts or unable to make payments or arrangements, sometimes it can be considered a standoff. So you can also, they will continue to try and collect, but if they can't garnish your wages or garnish your bank accounts or put property liens, that would be because your income is at or below the poverty level. If you're receiving government support, Social Security, SSI, or if you're disabled and receiving disability income, or if you're unemployed and you have no wages. You may be judgment proof, which means the standoff says that there's no workable solution to implement, and you would always want to seek legal advice. You can get a free consultation through a consumer law attorney. You might find yourself in this situation, but if you get a job again later, let's say you're laid off and you get a job later, you may need to look at bankruptcy protection to avoid them being able to garnish your wages, your bank account, or liens against your property. So that's the debt management seminar for you all. And here are some resources. The Certified Financial Board of Standards, which is where you can find a financial planner. This is the Financial Planning Association. We have a pro bono outreach. If you want to talk to a financial planner outside of these consultations that are available to you this week through Financial Planning Week. The Foundation for Financial Planning has some great resources available for you, and there is the National Foundation for Credit Counseling. So I want to thank you all very much for participating in today's seminar and watching the recording. And please enjoy the rest of your financial planning day activities. Take care. Bye-bye.